Good afternoon, everybody. Welcome once again to the weekly webinar presented by Affinity Federal Credit Union. Today's topic is annuities, retirement planning, and more. The 4 C's of retirement. So it's a great topic for us. I think I added this to the roster because it's important for us to understand what are the different ways that we can plan towards our retirement. So my name is Oscar Cordova. I am the Financial Education and External Affairs Manager here at Affinity. I'm in charge of the financial education efforts of the credit union for all of our areas that we serve. Today's presenter, his name is Tom Zubricki. Tom is a financial consultant with Affinity Investment Services. He's been in the business for many years, and he brings a wealth of knowledge to the table. So I encourage everybody to ask questions. If you guys happen to have a question during the presentation, feel free to use the Q&A option on your panel, and Tom will be more than happy to address those questions at the end of the webinar. Something else is the fact that this webinar is being recorded at this point, and later this afternoon, I will be sending a thank you for attending email where you guys will be able to access this recording at your leisure. So whenever you guys want to come back to it, perhaps you guys missed a topic or a concept, you guys want to re-see it again, you guys will be able to, okay? At the end of the webinar, I will also, and I'm sorry, on the follow-up email, I will be sharing Tom's information as well, because it's important that if you guys think that this is something that you guys want to pursue, it's important to have that conversation with a financial advisor that can actually can talk to you about the different options that are available to you. With that said, I'll turn it over to Tom. Tom, thank you so much for coming in this afternoon and presenting this great topic to our audience.
Well, thank you for that introduction. Oscar, can you hear me okay?
Yes, we can hear you.
Okay, perfect. So a little bit of housekeeping on this first slide. I am not an employee of Allianz or Allianz Life. Just a disclosure notice. We use Allianz's slides as a favor from Allianz because it's a relevant topic that we're trying to address today, and they provided the slides. As Oscar mentioned before, my name is Tom Zubricki. I am a CRPC, which is a designation from the College for Financial Planning, and that stands for Chartered Retirement Planning Counselor. I have over 40 years of experience. I was a trader for various Wall Street brokerage firms and banks over my history. And currently I am an employee of an Affinity Federal Credit Union. I work in the division called Affinity Investment Services. The FINRA, Financial Industry Regulatory Authority, the FINRA broker dealer that we use to provide a financial services platform for anything non-bank related is LPL Financial. So those are all the mentions on that first slide. I just wanted to clarify so people have an idea of what my background is and what we try to help people with. Okay, as I mentioned before, for housekeeping, I'm not an employee of Allianz. This is not meant to be personalized or tax advice. If you need personalized advice, please seek the advice and counsel of your personal financial advisor or your tax advisor before you make any decisions about investments or retirement. Okay. Okay, the other thing we do have to make note of, because I do work for a credit union, we have to segregate the difference between deposit accounts at the credit union, which are NCUA insured, National Credit Union Association insured, and are considered no risk to principal. If you have a relationship with the bank, the FDIC insurance, Federal Deposit Insurance Corp, is the insurance that's provided by a bank, and also that would be a deposit style account, which would be no risk to your principal. If we speak about investments, stocks, bonds, annuities, or other things like that, they're not insured by the NCUA, they're not insured by the FDIC, and investments might have a risk to your principal. So we have to make sure we have that distinction between one side and the other. Okay. All right, now this very next slide, it's already said you've worked hard for all your years to save your money. Well, I have to put an ad lib note in here. Okay, this is assuming that you're an older person and you're ready to retire. I might be addressing a lot of people who are younger, and that's fine too. But what I always try to tell young folks is, you have to have money to retire. I tell that to old folks too, right? But the most successful people I see are people who establish a budget first. So the Americans, an American economy, American business is very good at getting Americans to spend beyond their means. So what I mean by that is, as you start working, as you start earning a paycheck, as you start earning money from your business, wherever the source of income might be, you must live below your means. So have a budget, establish a budget, write it down, put it on a spreadsheet, whatever makes you establish a budget, make a firm budget, stick numbers in the spreadsheet, and make sure you are at the very beginning, make sure you're meeting all your expenses. As you get better at budgeting, try to make sure that you're consistently saving every month, because if you don't save, the next topic I'm going to mention is Social Security. The average person age 62 in America who files for Social Security and has worked for 45 years, the average benefit is probably $1,800, and that's before you later on you would deduct for Medicare, but it's about $1,800. So can anybody live in today's society on $1,800 a month? So that should be a wake-up call to say, we really need to think about retirement and accumulation and planning and budgeting early in our lives, so that it's easier as we go along and have better jobs and make more money and are able to save more and higher amounts consistently. Okay. The other suggestion I would make, again, before we get into the topics too much, is go to the Social Security Administration website and open an account. Make sure you're in the correct website, and ssa.org, I believe it is, but it should have Social Security Administration logos on there, and make sure you're in the correct website, and check your Social Security benefits at various ages, at age 62, at age 65, at age 67, at age 70, and see what that benefit would look like at some future date. And that will also say, okay, if my benefit's going to be X, then I need to know I have to do other things to supplement that benefit. Okay, that's, if you at one day will stop working, then you have to make sure you have enough money in retirement, and you have to make sure your money is working for you to accumulate assets, and you have to make sure your money's working for you to pay out extra income when you need it to supplement Social Security. Okay. Retirement is different today than it was years ago. I know my dad and a lot of other people's dads. I'm an older person, but I'm not retired. But I know people older than me had pension funds. Pension funds are probably a thing of the past, unless maybe you work for a state government or a federal agency. But for the most part, pension funds are a thing of the past. People used to have Social Security and a pension fund. Since pension funds are very limited availability for workers nowadays, we have to address that topic and say, if I don't have a pension, what else can I do, to provide for my retirement? Okay. Okay, the way I usually start a retirement conversation is, depending on what age you are, you have to start thinking about, where you go. Are you going to stay in New Jersey? New Jersey is a great state to work. It has a lot of high-paying jobs, but it's also a high expense state. Taxes are high, real estate taxes are high, so you can make good money, but there's a lot of drain on your money. So that's the first conversation I usually address with people. Are they going to stay in a state like New Jersey, or do they plan to retire to some other state that might be cheaper cost of living? When I have that conversation, I've had many people that said, well, Tom, I moved to Florida, or I moved to North Carolina, cheaper cost states. But the first thing they notice is they don't have a support group around. So their friends, their family, their usual places to eat or get medical care are all different. And you have to make an adoption to say, okay, I can handle that. Or some people say, well, I went there and I was miserable because even though it was a cheaper cost state, I wound up leaving my friends and my family, and they wound up coming back to New Jersey or the New Jersey, New York area, so they could be around familiarities like their family and their friends and their doctors and their restaurants and their hobbies, right? So that's kind of the first decision. Second decision, you know, a lot of people that I speak to are older and they're pre-retirees, so 5 or 10 years before retirement. Their main asset is probably their home, their equity in their home, or their 401k plans or 403b plans or 457 plans or IRAs. Those are all things we can address. But again, going back to my budget idea, you need to live below your means to consistently save to be able to put money into a 401k plan, 403b, 457, or IRA. And that's why budgeting is so important. And looking at your Social Security possible benefits in the future is an eye opener, and it forces you to say, okay, I need to plan consistently and save money every month. So that's why, again, I suggest budgeting. If you had to take a large sum of money and write a check from your checkbook, it's more painful. But if you budget a consistent amount per month and dedicate it towards a 401k or an IRA, it's an easier figure to deal with than writing a big check. And that's the most successful way to start planning and saving for retirement. Set a small budget, live below your means, and keep increasing the cash contributions to retirement. You don't want to ruin your life month to month, so make it doable, make it executable, make it livable. But again, it's all going to a future good cause, which is your retirement. And by that, I mean, you can figure out how to make contributions to a work 401k, a work 403b, a work 457, or an individual retirement account, a traditional IRA, or a Roth IRA. And you can still have other investment accounts or savings accounts beyond that. But it all comes down to the basics: budget, 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 save, 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 live below your means, and consistently do it. As I said, keep in mind that all that savings goes to a future good cause, which is your eventual retirement. Okay, so that part of what I'm speaking now is called the accumulation phase, 30 to 45 years prior to retirement. So people, from our children going to college and graduating. So, most kids get out of school at age 23, they get on their own at age 26. So there's your 30 to 40 years of accumulation phase. I can't stress again how important the accumulation phase is. If you don't budget, you don't accumulate, then you don't have a great future, being happily retired, right? The worst thing you can do is run out of money or not have money in retirement when you're not working and your health might not be ideal, et cetera, et cetera. Okay. Okay. Now, this is a kind of a relevant topic. This is the first time in 15 years. I used to trade fixed income, which is bonds and preferred stocks and things that pay a fixed rate of return for Wall Street. So this is the first time in 15 years with the Federal Reserve raising interest rates that I can actually have a conversation about CDs and about short-term fixed annuities and about US Treasury bonds and corporate bonds, things that pay fixed rate of returns, because interest rates are finally interesting. Okay, so the transition phase, you still have to have money to save, but the transition phase is people say, hey, I've been working hard my whole life. I don't want to lose money in retirement. So now is actually a good time, as I said, to address things that are safe, that will produce interest income. So it keeps your money working hard for you. You don't have to use the principal. You can live off the interest income from things like CDs and corporate bonds and US Treasuries and municipal bonds, et cetera. Okay. So that's the first time I can have that conversation in about 15 years, because interest rates finally have risen, but there's a two-edged sword to interest rates, right? the Federal Reserve seems to be trying to slow down inflation by raising interest rates. This was a drastic measure by raising interest rates, 400%, or 4% is 400% more than one. So basically, it's good if you're a conservative saver, but it's not good if you're trying to buy things. So it's not good if you're trying to shop for a mortgage, because mortgage rates are up. It's not good if you're trying to buy a car, or get a personal loan, or take out credit cards or personal lines of credit, because interest rates went up. So cost of financing is higher. What the Fed is trying to do is walk the line between slowing down the economy or economic activity to lower inflation and lower demand, because that's one of their mandates. They would like to keep full employment in the economy, but if you slow down the economy, you don't want to slow it down enough to start or put the economy into a recession. You still want to have full employment. The Fed's goal is 2% inflation. Right now, we're running at about 6% inflation. So those are the delicate lines we have to walk to figure out what's the right blend of investments, that will keep our money safe, will keep it growing, and help us out once we are nearing or in retirement. Okay. Again, this is all things I mentioned. Accumulation phase, you got to have the budget, you got to check the Social Security Administration, and you have to have enough money to retire. That's your accumulation phase. That's your original objective. Asset allocation is, I just started speaking about part of that, is if you wanted to keep safe money into all the money that you've safe investments in all the money you accumulated for retirement, you'd probably have that conversation about bank CDs or credit union CDs, certificates of deposit, time deposits, no risk to your principal, pay a decent rate of return, probably about 4% and change right now. And you can use the interest income if you need it. And there's no downside risk, there's no stock market risk in a CD. If you hold the money to maturity, the maturity date of the CD, you'll get your principal back plus the interest. So same thing, very similar to a fixed annuity, very similar to a treasury bond or a corporate bond. So again, first time we can have an asset allocation talk where interest rates are 4, 5, 6%, and we don't have to take undue risk to get a reasonable rate of return on a safe asset. Okay. Time horizon, again, that's all personal. But people like to start switching from more high risk equity or stock style investments. When the younger they are, as they get older, they like to say, well, I want to take less risk. I want to preserve my capital, preserve my principal, and try to get a good interest rate of return. So again, I'm happy to have a conversation about fixed rates of return on all those investment style vehicles. As I mentioned earlier in my conversation, you don't want to outlive your assets. You don't want to, last year was a terrible year in the market. When I say the market, I mean the stock market in general. The Standard & Poor's Index, which is the standard measure of the stock market, was down about 20% last year in 2022. The Dow Jones was probably down about 15%. That's a more conservative index with less components. And then the NASDAQ 100 was probably down about 32%. That's more tech related and more new company growth related. That's a horrible rate of return. But, that is where some people are allocated. If you're younger, can you take more volatility in that sector of the market? Or does that keep you from investing in that sector of the market ever again? What you have to realize, and I always try to tell folks to look at things, you want to look, when you do an investment in the stock market, you want to look at 1, 3, 5, and 10-year rates of return. You want to be in a sector of the market that you think is going to be growing and surviving and growing. So my example, if I think about tech or healthcare, tech was hit hard last year. It was down about 32, 35% technology. But tech, the last years prior to that were up 40, 50% in 1 year, maybe even higher. So what you want to look at is tech still a legitimate sector? Is it still going to grow? Is that where all the new ideas and processes and inventions coming from? Yeah, probably. Whether market price is too high for tech last year, and did the market adjust for them? Yes, probably. And my average rates of return over a 10-year period in tech are probably between 12 and 15%, even though last year they were off 32%. So I don't focus on 1-year rates of return. I want to know if I want to be in a sector like tech or healthcare. Healthcare is even a better example. Healthcare, again, all new technologies. There's higher demand for healthcare. As we all get older, we use more healthcare. New vaccines, new machines, new biotech, new treatments, new everything, new procedures. Is healthcare ever going to go away? No. Did it have a bad year last year? Yeah, it was off with the rest of the market. But if I look at the 1, 3, and 5 year, and especially focus on the 10-year rates of return, when I'm a long-term investor, I want to focus on 10-year rates of return. And I'm not necessarily concerned with the 1-year rate of return, because what most people would do, they'll look at their 401k plan allocations. They'll see, okay, what did best last year, and they'll allocate money to what did best. But that's the wrong thing to do, because then you're buying high. If something just had a great year and you're putting more in it, then you're buying when prices are high. I want to look at the 10-year rates of return. I want to know that I'm in a good sector. And then I want to try to be a contra investor. I want to buy when prices are down. So I might buy tech or healthcare if they had a bad year, because I know over 10-year periods, they're going to return to the mean and out earn other asset classes. Okay. Again, that's just my opinion. I can't tell you what to do. I can talk to you about it on the side if you'd like to have a conversation. I cannot give individual financial advice over this presentation. It's just my opinion on what people should look at. Okay. And time horizon, if you're in the accumulation phase, obviously you're probably willing and able to take more risk. So your allocation to stock or equities. When I say equities, those are growth style investments. Your allocation to equities probably higher than it would be if you're, my age, which is 64. I might not have as high an allocation to equities when I'm going into retirement, although I'm not retiring anytime soon, because I want to be more conservative with my capital and my principal. I don't have more time to wait to accumulate my assets. So, people get older, they tend to get more conservative. That's all we're speaking about with financial objective, asset allocation, and time horizon. Okay. As I said, the worst thing you can do is have to withdraw money when the stock market, if you're fully retired and if the stock market's down 25% and you need money to live on, now you're depleting your account that's already down 25% if you have too much equity or too much risk in your account. So not only did the market deplete your account value, you also depleted your account because you needed to withdraw some money to, supplement your living expenses. So that's another reason why you have to speak about asset allocation and is it the right strategy, okay? You don't want to have to withdraw money when the market is down and, depleting your assets. If you're not working anymore, if you don't have a way to add to your assets in retirement, then you don't necessarily want to deplete your assets when the market's down and when you need the money. That's why you need to have diversification and different asset allocations, for how you feel about risk and financial objectives. Okay, so, we're talking about the 4 C's in retirement. Clarity is everything we've been discussing. Clarity with where you want to live, clarity with how you're going to set up a budget, clarity with what kind of income you'll have from Social Security, clarity with, how much money should I put into various retirement plan options that I have. That's the clarity portion. Budgeting, dedicated money, to certain baskets for retirement. That's the clarity part, number 1, to start with. Gather facts, figure out what you need to do. As I said, the most successful people I deal with are people who live below their means, who are consistently able to save every month to month, and who consistently contribute to retirement savings accounts, retirement accounts, and investment accounts. Okay. If you don't have money to save, if you live over your means, then, we can't have a retirement conversation. It doesn't make sense. Okay. So now, I'm just going to go through some of these sources. Gathering facts, income strategy loan. Well, again, nobody knows how long they're going to live. In general, I usually tell people, if you your parents, your grandparents, if you have good genes in your family, if you think you're healthy, if you feel that you're healthy, it might make sense to defer your Social Security and defer your retirement to a later date, right? You know, keep collecting the assets, keep working, put money away, and maybe you defer assets to a later date. You know, with Social Security from age 62 to age 70, you know, let's say just for an example that my full retirement age is 67. It's a little lower than that, but I'm just making an example. Every year that I take money out early, I take an 8% haircut to my annual income from Social Security, about an 8% haircut. So if I retired at age 62 and versus age 67, 8 times 5 is 40, I'd get 40% less than my Social Security benefit at age 67. But there has to be a trade-off. If I didn't collect 5 years of monthly income, I needed to live longer with the higher payout to make things break even or come out ahead of the game. That's why I said I usually tell people, look at your family, look at your personal health, look at your family genes. If you think that you have longevity liens and you have a healthy lifestyle, then maybe you defer retirement to age 67 or 68 or 70. If you don't have a healthy lifestyle, you don't have healthy genes, then it might make sense to, you know, retire early and enjoy what you do have. But again, you still have to have that planning stage to enjoy what you do have, whether it's at age 62, at age 67, or it's age 70. Okay. Now, inflation protection. Again, inflation hasn't been an issue for probably 25 to 30 years. It's been hanging at that 2% level until just recently. And inflation, you know, last June it was reported at 9%. Recently, it's reported at 6%. So if you can only earn 4, 5, 6% on your money, and inflation is raging at 6, 7, 8, 9%, that's a negative spread on your money. That's not good. I mean, the Federal Reserve is trying to fix that, but that's why we like to have equities or stocks that can that can try to outpace the inflation that's in the economy. I mean, I think inflation's coming down and it will continue to come down if the Federal Reserve keeps, you know, doing its tightening policies. But again, it's something you always have to keep in mind. You know, if you are a conservative saver and you're age 65 and you have $100,000 in the bank and you're only earning 1% on it and inflation is 7%, essentially you don't even spend a dime and you're losing 6% of your purchasing power because inflation is out earning your interest rate, right? I mean, that's not the fact right now. As I said, you can probably earn 4 to 5% in CDs and safe money, and you know, you can probably earn 5 to 6 to 7% in other fixed income ideas. So there's a way to battle inflation and still stay safe, and then maybe add some equities for potential growth. The S&P 500, for the most part, over long periods of time, that's the standard for the stock market. Gross returns on the S&P 500 was probably about 8.6%. So you might not have a full allocation to the S&P 500, but you want to have maybe some allocation, and you blend all those rates of return together. So if you can get 8 or 9% on the S&P 500, if you can get 6% on a corporate bond, if you can get 4.5%, 5% on a treasury or a CD, you blend all those rates of return together, you manage your risk, you have portfolio allocation and diversification, and that's the way you fight inflation and keep your assets growing and safe. Okay. I'm not going to address estate distribution strategies too much. We're more on the retirement questions, so we can address those on the side if somebody really wants to do that. How much income do I need in retirement? Well, if you have a budget, you know what your expenses are, right? So if you know what your expenses are, and if you know what your income from Social Security is, and if you know how much income you're going to either take from your retirement plans or earn from your savings and et cetera, then that's the very basic budget that we have to work with. How much income do you need is a function of how much do you spend, right? What sources of guaranteed income do I have? Well, savings with a fixed rate of return, US Treasury bonds, CDs, corporate bonds, other fixed annuities, things that pay fixed rates of return will give you a guaranteed source of income without a lot of risk. So that would be the second bucket. What sources of income do I have to supplement my Social Security, or if I'm lucky enough to have a pension? Risk tolerance, we've kind of addressed a little bit already. As I mentioned, the safe assets are the first, the fixed income style assets. And if I can get a reasonable rate of return on that basket of assets, then obviously I can make my principal last longer without having to spend it. How many years can I live in retirement? Again, well, that's, people are living longer. Why? We're spending more on healthcare. There's better healthcare techniques, and people are living longer. They're healthier, etc. So, people used to live at a lot. They used to pass away at a lot earlier age than we do now. I believe, and unless the slide's going to tell me wrong, for life insurance purposes, the average age of a healthy male in the United States is probably age 78, and it's probably age 82 for a female. If you're age 65 already, the age, the life expectancy age is probably a slight higher because you've already reached 65. Okay, so let's go to the comfort part of the C's. Again, this is what I started addressing earlier. Excuse me, I need a little bit of a sip of water. Where do you want to live? What's your budget going to be? What are your spending needs? What's important to you? What's around you? Do you want to play golf? You want to go fishing? I don't know, hunting, tennis, you name it. You got to figure out what's important to you and try to, the worst thing, that people tell me that are retired is like, hey, I'm bored. Have a hobby, go see your family, go see your friends, plan for living somewhere where it's going to keep yourself active, both mentally and physically. Try to keep your good health physically, try to keep your acuity, your mental health by, reading and puzzles and just doing things that interest you. So that's all part of what the conversations that I have with folks about where they're going to go and what they're going to do, right? The company that made these slides is an annuity company. There are all types of annuity products that will or could provide guaranteed income. It's not really for our conversation today, but just as a highlight topic, there's fixed annuities, there's fixed indexed annuities, there's variable annuities. Various annuities have income producing features, whether they're a period certain for 5 years, 10 years, 20 years, whatever, or whether they're fixed, where they pay out a fixed payout for life. Again, that's for another conversation, but that is another tool that we could possibly use or discuss to make sure you have enough income in retirement, right? The thing you have to remember about an annuity or a life insurance company, an annuity is a contract between you and a life insurance company. And in the contract, it lays out the rules and roadmap of the annuity. So if you adhere to the rules, the company adheres to the rules. The main thing you have to remember about an annuity is not insured by the FDIC, so it's not a bank deposit. It's not insured by the NCUA, the National Credit Association, so it's not a credit union bank deposit product. It's based on the claims paying ability and the credit rating of the insurance company that you deal with. So you want to deal with a good quality insurance company, not Joe Schmo insurance from, some Midwestern state that you never heard of. You want to deal with a good high quality insurer with a good credit rating, because if you're going to entrust a portion of your money with an insurance company, you want to make sure you get your principal back with the interest or with the benefits that were agreed to in the contract. Okay. As I mentioned before, people tend to be living longer. What usually happens in retirement, people who retire earlier than they thought, it's either from a layoff, from a job change, or from a health issue. So, no one knows what's going to happen. We don't know what health issues we might run into, which is why, again, I'm going to stress the fact that there's no time as too early to start accumulating assets for retirement, right? We don't know what's going to happen. You might be forced to retire at age 60 or 62. So if you don't have the ability to work, then hopefully you have saved some other assets to supplement whatever you might get at an earlier age, which would be a lower number. Um, you know, as I said, if you look at this chart, a lot of people now who thought they were going to retire at full retirement age, again, just for my example, let's say 67, retired earlier than planned because of what I mentioned. It might be a health issue or a job issue or a family issue where, they had to help a family member or a layoff or things like that. So just keep in mind, it's not meant to be a static tool when I talk about budgeting. It's meant to, think about on an active basis, and the earlier you can start, the better. Okay. And here's, as I mentioned already, health problems or care for another spouse or family member or job or downsizing. Those are the early, the reasons that people might have to retire early that they didn't expect. Okay. We had a horrible stock market last year. We had a horrible bond market last year. Nothing worked in the market. Even bonds lost money last year because interest rates rise. There's a negative correlation. If interest rates go up, prices of existing bonds go down. Okay. I don't want to have a big conversation about it, but that's part of the problem that, some of these banks that you heard about over the weekend that had issues, they didn't adjust for their interest rate risk. And I don't want to go too deep into it, but essentially, like I said, now is the first time in a long time I can have a conversation about bonds that have a real rate of return. So there, you'd want to have other assets in your portfolio for retirement, so you don't have to deplete assets when the market's down. Okay. So some people, want safety over return, and this is what I started addressing earlier. If a person can, I had a meeting with a couple today, and they're getting a decent settlement, and it's a life-changing amount of money, but they don't want to take market risk, and that's absolutely fine. If you can get a rate of return without taking stock market risk, and if you can live off the interest income, that's absolutely fine. So a lot of people will say, hey, if I don't have to worry about market risk, I'm willing to take a fixed rate of return if my principal doesn't lose value. But again, depending on where you are in life and where you are in the accumulation cycle, and depending on what interest rates are doing, depending on what inflation is, sometimes you need to add some other investment vehicles for growth potential. Okay, what I mean by that is like stocks. Okay. So spending patterns in retirement, again, this is all personal budgeting things. I don't get into too much of spending with my clients. If they're adults, if they're able to run a budget, if they know what their income is, if they know what their expenses are, I don't have to go through, cable bills and healthcare bills and health clubs and golf fees. That's up to you, personal level. But American public is very good at confusing needs versus wants. Okay, needs are, when I'm retired, what do I need? Well, I need shelter, I need healthcare, I need a good, safe neighborhood to live in, I need the basics for, phone, food, transportation. But America is very good at saying, mixing up a need with a want. Okay, I drive an old car and it's got 110,000 miles on it. Do I need a new car? Nope. My car runs fine. So do I want a new car? No, not even really, because I don't have a bill and my car runs fine. But some people have to have a new car every 3 years or 5 years. Do you really need a new car? Or do you want a new car? So that's the keeping up with the Joneses thing, which you don't necessarily need to do. That's a personal choice, but that's all part of the retirement planning conversation. Live below your means and save money. Do you really need a new computer? Do you really need a new laptop? Do you really need a new cell phone? Do you really need a new pair of Air Jordans? Whatever. You have to be practical and live below your means, and don't confuse your needs with your wants. Okay, that's what this slide is trying to address. Wants, could you take a vacation? Yeah, but I tell people, I don't want to see people take a vacation and put it on a credit card and pay a 22% interest bill. credit card is the worst kind of spending you can have, because just think about it this way. I've seen people with, 50, 70, $100,000 of credit card debt, which is in my brain ridiculous. But as an example, right? If I have a $50,000 credit card debt and I'm getting charged 20% interest, just basic math, if I don't spend another dime, I got to pay $10,000 in interest expense to service a $50,000 credit line, and I didn't even buy another thing. So it makes no economic sense at all to get charged 20% to go on a vacation. Save money and budget, and don't have a 20% bill on a vacation for something that you felt you needed, but you really didn't. Okay. It might be a want. Everybody likes to take a vacation, but put things into perspective. That's my main concern. Put it the other way around. If I could say that I can offer you an investment that pays me 20% every year, I'd have a line out the door, right? So don't let the credit card companies take advantage of you. Use the credit responsibly, check your credit rating, especially younger people, accumulators, check your credit rating, make sure you know it's good, make sure you're paying your bills earlier on time, and use credit as a 28, 30-day revolving credit facility. Pay the bill off and, take advantage of are there cash back cards. If you pay your bill in full, you might be able to get cash back. The cash back you get on a credit card, put it in an investment account or a 529 plan or IRA or whatever. Use your credit wisely. Don't let the credit card companies use you. Okay. Wishes. Well, basically, needs, wants, and wishes. Once you're retired, people can say, well, I want to leave a legacy for a charity or for my beneficiaries or for my children or for a charitable institution. That's a whole nother conversation. That's where life insurance might come in, or having named beneficiaries on your retirement accounts. But nowadays, with things being so expensive, people, for the most part, average people like most people are not super planning on leaving money for beneficiaries because they're trying to live and get through inflation, right? We all know the cost of food and oil and gas and clothing and everything has gone crazy in this last year. So again, this is why you want to have a conversation with how you're saving and how you're spending and how your assets are invested and what rates of return you're earning on it. As I mentioned, we've been in that 2% inflation window for a long time. The 70s are gone, but I don't want to see the 2020s come back with a 6, 7, and 8% consistent inflation handle. If that happens, then obviously we have to do things, to make sure we don't outlive our assets and we keep up our purchasing power, right? As I mentioned before, if you have $100,000 in the bank and inflation's 7%, you're earning 1%, that's a negative spread. That's not a good place to be. So, thank God, or thankfully, interest rates are up and bank deposits and CDs are paying more, and they're at least chipping away, keeping up with inflation on a more equitable basis. These are all things we've been speaking about. Speak with a professional, check your Social Security, see what your cost of living adjustments are. Again, that would all be available on the Social Security website if you're in retirement, or that would be more related to if you're in retirement. You can see what your cost of living adjustments are based on inflation and CPI and PPI and reported to the government. Consider a lot of different things to diversify your assets. So everything I mentioned: stocks, bonds, mutual funds, CDs, treasuries, corporate bonds, annuities, growth portfolios. There's a lot of different things that we can talk about to build the portfolio over time, right? If we're going to live longer, then we need to know that we have income, and I don't want to deplete assets. So, this is a side topic, but I build portfolios that produce a certain amount of income, and people don't have to spend. They don't have to sell anything in the portfolio to live off the income. That's the same theory behind some of the variable annuities. They have what they call GMIB, guaranteed minimum income benefit payments. So they'll make it an income benefit payment for life. So you can use various annuities to supplement your Social Security and other retirement income. I was pretty close before on my life expectancy table. But again, this is really for life insurance purposes or for planning purposes. If we think we're average, then we got to plan for ages 77, 78, and ages 82. Market volatility, I've already addressed this. The sequence of returns, if somebody retired last year in 2022 and they were 100% invested in stocks and they had $1 million, and in general, the market went down 25%, it wouldn't be real happy day if you looked at your 401k or retirement statement and said, oh, my $1 million turned into $750,000 at the end of the year. That's where we're talking about sequence of returns. So that's a negative sequence of return as soon as you're entering retirement. That's very hard to overcome because you'd have to make a 50% rate of return on your remaining assets to overcome the 25% you just theoretically lost. And you also might have had to take money out and you're depleting assets at the wrong time. So that's, again, why you don't want to have all your eggs in one basket, and you want to diversify your holdings and figure out what your bills are and where the income is going to come from. Okay. You don't want to deplete the assets. If you want to look up the old rule of thumb for retirement assets, if you had a 60-40 portfolio, stocks to bonds, and you were a moderate risk investor, it's estimated that your portfolio would last until age 95, from age 65 to age 95, if you only took a 4% withdrawal rate from your account. Okay, but by age 95, your assets would be depleted. Some people don't like that. So that might not be the right formula, but then again, not many people live to age 95, but some people do. Okay, so that's all part of the planning process. How much assets do you have? What's the rate of return? What's the depletion rate? If you think about RMDs, required minimum distributions from tax deferred retirement accounts, the first distribution percentage is about 4%. And now the age scale went from 70 and a half up to age 73. There are still some people who are older that have to still take RMDs at lower ages. But, or the new tax acts that just passed, increased the RMD requirement minimum distribution age out to age 73 for most people going forward. But the distribution rate's still about 3%. So in theory, as I said before, you want to have a mix of assets that earn you maybe an average rate of return of 7 or 8%, right? So if I have bond assets that are earning me 4 or 5% or 6% in returns, and savings accounts, things like that, if I have a basket of equity and income securities that are earning me 8 or 9%, maybe my average rate of return is 7. So if I'm not working anymore, I want to make sure my rate of return on my investment and retirement portfolio is exceeding my distribution rate required by the government or required by life, right? If I can earn a 7% rate of return and I only have to take out 4% distributions, and that is enough to live on, then my earnings in my portfolio are going to outlive my distribution rate, and therefore I should not run out of money in retirement. Okay. That is, again, now there's another consideration, unless you might have had a long-term care expense, but that's a whole nother insurance topic. Okay. I've kind of been addressing all these topics all along, so I don't want to delve too much into these slides because it's just talking about sequence of returns. The more important things to think about, as I said, we've talked about clarity, we've talked about comfort. By comfort, that also means risk level. And I did mention risk level before. You have to be comfortable with the risk you're taking. If you're not, then make sure you are, right? I always tell my clients, it's your money. There's no more important shepherd of your money than you. So you have to be comfortable with what you invest in and being willing to take that risk. Don't take any more risk if you're not comfortable doing it, right? Only do what you're comfortable doing with your money, because you're the most important shepherd of your money. We've addressed the cost of living and inflation. Hopefully the Fed can get inflation down. Right now it's an issue, and it's a delicate balance of trying not to cause too much demand destruction to put the economy into recession, but keeping enough growth in the economy to not go into recession and keeping interest rates reasonable. Right now, that's affected the borrowing market, so mortgages and consumer credit and auto lending and personal lines of credit. Right now, there's a drag in that sector of the market, but it's a boon for people who love to get a fixed rate of return and not take much risk. So, we have to address those things on a personal basis. And then clarity or certainty, deliver solutions. As I said, that's what I'm here for, to talk about how we can deliver a solution, whether it's a mix of assets or whether it's, CDs, US Treasuries, corporate bonds, maybe a blend of stocks that pay dividends, fixed annuities or variable annuities or fixed index annuities. Blending all those assets together is probably better than choosing one asset class and you look for the overall rate of return and try to get to where you want to get. Okay. So I'm sorry, Oscar, I just hit something where I lost the screen, but I think I was at my last slide sequence that I wanted anyway.
That's okay, Tom. Okay, so if you were about to finish the presentation, so now this will be the time for me to open up the floor for any questions that any one of you may have. Now, Tom did go over a lot of different topics, well, not topics, but a lot of different concepts. And now is the time to ask questions. Now, in the follow-up email, as I mentioned before, I'm going to include Tom's information in case you guys think of a question after we finish this session today and you guys still wanna get an answer for your question, or if you want to go ahead and sit down with Tom and go over a brief conversation around what are your plans and for retirement and retirement planning. All of these sessions that we provide are free of cost, as well as the appointments and sit downs with our financial advisors with no commitment. So you guys can just have a conversation with Tom and see what he says. So, okay, so I do see here a question being asked, and the question reads, Tom, what are the chances that Social Security would even be available 10 to 15 years from now?
I think that's a very important question. I don't have the answer for it. That's from our wonderful politicians in Washington. It's a political issue. If I paid into something for 30, 35, 40, 45 years as a consumer and as a US citizen, I would really want to make sure that my politicians knew that I would be adamant that something I paid into better be there when I retire. So I don't think that if the politicians are wise, I don't think they would want to get voted out of office by the block of AARP or senior members to say, oh, we can't pay your Social Security benefits. I think that's something that'll probably never go away. Again, just my opinion, our government can spend on gazillions of things. They better make sure that they have a Social Security administration and benefit that was promised for people, hardworking citizens of the United States that expect the money to be there. Okay, they might try to make adjustments to age where your collecting age is higher or your benefits are adjusted. I would even hate to see that, but I honestly can't give you that answer, which is all the more reason why you need to save and plan and have other sources of retirement savings and income. My own opinion, I don't think Social Security will go away. It might change, but I'm not a politician. I don't work in Washington, and that's why I stress budgeting and saving and other things. I know it's a roundabout answer, but that's the best I can do.
Fantastic. Thank you so much, Tom. All right, very good. Let me just see if there's any other questions being asked at the moment. All right, I don't see any questions at the moment, but like I said before, if you happen to think of a question after we conclude this webinar, feel free to send it to me via email or directly to Tom to the information that I will be providing shortly. Oh, no, one question just came through. All right, I am about to be 62. Where should I put 401k if I take it out of my company?
again, I cannot offer personal financial advice for someone that I haven't had a deep conversation with. So if you'd like to discuss that on the side, I can certainly do an account review with you and see what works for you. But for a general answer, I can't do that on this call. That's kind of what I was referring to at the beginning. You know, I need to know more about you, your personal situation, so that I could give you sound financial advice. I can't do that with just a general question. Sorry about that.
Yeah, very good. And a follow-up question to that is, are you in the Edison Affinity, in the Edison branch, or can you get there?
Well, technically, it's not my branch. That is covered by another financial advisor. We could have a conversation. I could refer you to the financial advisor in Edison if need be. So we can figure that out. But we can have someone speak with you one way or another. Just, you know, send us a note, let us know what you need, and we'll make sure we reach out and have that conversation with you.
Fantastic. Yeah, thank you so much. Yeah, if you live nearby at one of our branches, we have multiple financial advisors that are assigned to different branches. So if you want to have a conversation, of course, Tom, by being the presenter today, will be the person to have a conversation around retirement planning. But if you prefer to go into an office and have a conversation on a one-on-one basis with the local financial advisor, you can always reach out to me and I'll find out who that person is and refer you to that person.
Yeah, our financial advisors are all qualified representatives. As I said, it just depends on which branch they cover. So I would not cover Edison, but we'll find out and get you someone, not find out, we'll get you some, or we'll get you in touch with someone who can help you.
Fantastic. Very good. Let me see if there's any other questions being asked. Okay, I don't see any anymore. So at this point, I would like to bring this webinar to a close. I hope it was informative to all of you. Next week's presentation. Oh, I'm sorry. Are there fees for consultation, Thomas?
No, it's an open conversation. No fees. You know, we're not doing any financial planning. We're not doing spreadsheets. We're having a conversation to see what you need and see if I can help you and to see if we have a meeting of the minds. If we do, fine. If we don't, fine, but there's no fees to have a conversation and a consultation. No.
Fantastic. Very good. All right. So as I was saying, next week's webinar will be on identity theft. So the email that I'll be sending will have also the link for you guys to register for that one if interested. Okay. Follow-up question to the previous one, Tom. What are the fees for planning? And that's kind of like a loaded question because there's many different things that you can plan for, correct?
Correct. Yeah. Again, that would have to be a more, you know, personal conversation to see what your needs are. So I could honestly, I couldn't give you an answer until I know what your needs are and the extent of the planning. Sometimes planning is just all the topics of the conversation or the presentation I just made. It's not super intensive where you need a spreadsheet and tax advice and estate planning. Some things are just, hey, what's the right blend of assets and how do I make my, you know, assets grow and last in retirement? So there's limited planning and there wouldn't be a fee for that. You know, if you need a planning with a spreadsheet and, you know, tax advice and everything else and estate planning, that's a totally different subject. So again, depends on the need and it depends on the conversation. So again, not something I could address on this conversation, you know, over a presentation.
Very good. Next question, Tom. I live out of state, but now, but still a member of Affinity. Can we still talk?
Sure. Yeah, I just have to be registered in the state in which the person lives. I'm registered in a lot of states in the United States. U.S. securities law says, you know, to speak about securities, so anything other than bank deposits, I, as a licensed financial advisor, need to be registered in the state where my client lives. So, you know, I am registered in quite a few states, not every single one, but, you know, we can cross that bridge as we need to.
So this member lives in Delaware.
Yeah, I'm registered in Delaware. I have clients in Delaware.
Fantastic. Very good. So then we can make that connection happen between you two.
Yeah.
Fantastic. Okay, very good. All right. So I'll give it another 10 seconds or so for any other extra questions that you guys, any one of you may have. In the meantime, as I was mentioning, the link to register for next week's weekly webinar will be on the follow-up email. So feel free to do that. Or if you guys want to just visit our website, the list of all of the other weekly webinars until the end of the quarter is up right now. So you guys can register for any other one that you guys may be interested in. All right. So with that said, I don't see any more questions. So thank you everybody for attending. This has been great. Thank you, Thomas, thank you, Tom, for delivering this topic to our audience. Do you have any parting words, Tom?
No, you're welcome, Oscar. You know, what I speak about is in my blood. It's in my nature. I've been doing, Wall Street and investments for over 40 years. I enjoy having these conversations. I enjoy helping people. The nice thing about working at Affinity and with LPL is I don't have any mandates. I don't have any quotas. I address people's needs based on the people's needs, not my need to sell something. I don't need to sell anything. So that's the nice part. We're no pressure, low pressure sales. And as I said, I don't have any proprietary products. I don't have any quotas I need to meet. I base my financial advice and guidance on the needs of the customer and not on the needs of me to sell something, because I don't have a need to sell anything. So that's why I like being with LPL. That's why I like being with Affinity. We're a lot different than other financial organizations, to the members' benefit.
Excellent, very good. One last comment made by one of our members. They said that it was a great presentation. So,
well, wonderful. Thank you very much.
Yep, I'm happy that you guys liked it. That's the whole point of making these weekly webinars for you, for our membership. With that said, I hope to see everybody next week. You guys have a wonderful evening, and please be on the lookout for the follow-up email. Thank you so much. You guys have a wonderful afternoon. Thank you.
Yep. Thank you, Oscar. Thank you, everybody.
Okay. Bye-bye.